Welcome guys to another episode here at the Inner Wealth channel. Super happy to be here with you guys. As always, my name is Bastian, and today we're going to episode 3 of our ABCs to Smart Money Concepts playlist. Okay, today's third episode is all about liquidity. Okay, episode 3 is all about liquidity. So with that, guys, I should state by saying, and you guys know this by now that you've heard my previous episodes or seen my other episodes about this subject, is I believe the market is liquidity engineered. Now, without getting into super in-depth and advanced technical analysis, we're going to go through the very basic, raw understanding of what liquidity is. And for that, I believe the best way to start is by understanding what liquidity is to begin with. On a definition standpoint. So write this down for me. Liquidity is the measurement in which we see the volume of market participants at that given moment. So liquidity can be multiple levels of price action, can be created over a long period of time, a quick period of time. Liquidity visually, okay, the definition is the measurement of how many participants there are at any given time. Okay, I'll also put that up on the screen for you guys. The measurement of how many participants there are at that given time. So with that, visually, how do you identify these things? Is, well, when there's a lot of market participants, what you will see price action do things like this, okay, where it'll just move back and forth. And this is what I call very healthy price action, okay. And the reason I consider it healthy price action is because unhealthy price action is, as you guys saw in the previous video, is imbalances, right? That's unhealthy price action. That's price action that was distributed on one side. So healthy price action, okay, by means is the very opposite. It's when price action goes back and forth, back and forth, back and forth, and you see a lot of liquidity buildup. Now, liquidity is induced into the market. These institutions would much rather take everyone's stop losses who are buying to go long on silver, and then go in the direction of the market. And how do they do this? Is by running on liquidity. Okay, sweeps of liquidity are going to be, some of them are very easy to locate, some of them maybe a little bit more difficult for you to adjust to. But I promise you, diving into liquidity, you'll truly understand the nature of the market. So as you guys can see here, you got all these equal lows right there. Okay, and so we're going to actually put a nice money sign right there. Identifying liquidity are also known as pools of money. Okay, and when pools of money are ran through, you can see that price action impulsively makes a new higher high. So write this down. Liquidity and structure go hand in hand. There's no one that comes before the other. No, liquidity and structure go hand in hand. Okay, so now you may wonder, why liquidity are these equal lows considered liquidity pools? Now, liquidity pools is where a vast majority of market participants, okay, just like in liquidity definition, it's where a vast majority of market participants' stop losses, okay, rest. So as traders, you guys will learn that proper risk management is key. And so there's a lot of bots out there, hedge funds, institutions, entities, participants that have on a regular basis, a lot of them have this very great general understanding of buying low and selling high. Okay? And the reason that they do that is because a lot of these participants, let's call them, what they do is they'll buy low and set their stop loss at the low of the month, at the low of the week, or at the low of the day, or even at the most previous low on the 1 hour, on an intraday perspective, right? And the reason they do that is to trade manage their risk, okay? So they're giving themselves an anticipated or a predetermined amount of risk or room for the trade to either go their way or prove that their trade is incorrect. And so what a lot of the most obvious and free content that you guys see out there are things like double bottom pattern, for example. Okay, we're gonna learn this one. You guys are gonna see it a lot. Okay, it's that double bottom concept that a lot of retail traders believe to be the bottom of a trend. And I'm not here to bag on retail traders, not one bit. I know many retail traders that are 6-7 figure traders. All respect to them. Okay, but this is what the most individuals, putting aside all the successful ones, what they do and look for is the double bottoms patterns, or what these algorithms or bots do is they look for these patterns, and they're set upon this algorithm to look for this level of this double bottom, you could say, here, okay? And as you guys can see in price, what happens is we come down one more time. Now, on a line chart, we may not see that. It may seem like a triple bottom on a line chart. But then here you can clearly see that price indeed push down all the way through all those liquidity, through everyone's stop losses. Anybody that bought at this level, bought at this level, bought at that level, they'll probably put in their stop losses right below the lows. So those are the stop losses that got ran. And this is why we like to wait for liquidity before an entry and aim for liquidity after an entry has been made. Okay? So now, for example, we'll look at what happens on another asset like the DXY. The DXY is the US dollar index, and I want to show you guys a example of how the DXY has essentially done this multiple times as well. And the best example I can give you guys, let's see, is a little bit more current price action. Okay, last week, don't mind any of my markups. Let me actually switch this guy, DXY. Let's go to capital.com. Okay, so on this guy, we were looking at bearishness, lower low, lower high, lower low. Okay, and when we were at this lower high, okay, we can go down to the daily. Okay, when we were at this lower high, we were looking at this whole range from this high to this low. Okay, and an area that I was potentially looking at was this gap right here. Okay, that gap right there was an area of insufficiency where I wanted to see price action return. Well, just like you guys can see here, I'm going to help you train your eyes to see these type of things. Starting at this high to that high right there, we create two very relative highs. And then you can see on a daily a lot better. See? High and high. Okay? Very relative highs. And what happens is the very next day trades into the gap, takes out previous highs, and then distributes. Okay? And continues to fall. And you guys will see this happen again and again. If price action needs to sell off, it will take the highs before doing so. Why? Because they do not want, this is a whole daily, 2 daily candles, right? 2 daily candles right there that got swept. They do not want everybody from the day of December 2nd, the high of December 2nd and the high of December 6th, to profit on any upcoming shorts, regardless of their understanding of the market or their bias being correct. Okay, these markets are liquidity engineered. They're engineered to run on liquidity. Okay, so what they'll do is reverse price action, okay, create more liquidity, and then what? Takes it out and falls. Okay, then what do? And we do this again and again, as you guys can see, even today. Okay, we come above the highs, equal highs right there. And so if we were meaning to sell off, we will do so by taking out the highs. Okay, now let's go look at some bullish examples as to when this takes place as well. And I believe one of the best assets that shows that is Dow Jones. Okay, so we'll come back and look at Dow Jones, and you guys can see, one sec, Dow Jones does this a lot on a daily time frame. So let's go look over here. How Dow Jones tends to do these things a lot. So what I want you guys to see is that it's even on the higher time frames, you guys can see these very, very clear. So not all liquidity has been taken here, but it's being built up. That's a level of liquidity. That's a magnet for price. Okay, liquidity, the best example that I can give you guys of bullish liquidity sweeps is, understand this by first giving you guys the understanding that liquidity pools and liquidity levels don't have to be the same thing. Liquidity pools is when multiple candles, okay, line up at the equal lows, like so. Multiple candles are building up that liquidity. That's a liquidity pool. Okay, a liquidity level can be any previous, and write these down, any previous monthly high or monthly low, any previous weekly high or low, any previous daily high or low, any previous Asian high or low, and any previous 1 hour high or low. Okay, these are all levels or types of liquidity. Okay, these are all types of liquidity. All right, the Asian high and low with the 1 hour high and low are actually intraday levels of liquidity. Okay, so as you guys can, I'm going to show you guys an example of how that works. Now, you guys know what liquidity pools are. Now I'm going to show you what just the liquidity level is in overall. So here you guys have liquidity pool, relative highs, right? Liquidity pool get ran through. Okay, and as you guys can see here, right before we have a really strong push down, after sweeping major liquidity, we sweep another level of liquidity. Now I mentioned it before, we're on the daily time frame. So what happens here? 1, 2 pushes to take out that high. Then before we fall, we take out that previous daily high right there. What happens? We fall for 1-2 days. Okay, then we have another bullish push up, 1-2 days. What happens before we fall? We take it out, we sweep liquidity, and then we move to the downside, sweeping that previous daily high. Why? Because they do not want people from the previous day, okay, that shorted, to profit from tomorrow's shorts or today's shorts. Okay, that's why they do it on a weekly base, on a weekly level. That's why they do it on a monthly level. Okay, this is a previous monthly high right here. That's a monthly candle. So that's a monthly high. We come up to it. They do not want everybody from these months to profit. So they come back, take them out, and then run for the lows. On a weekly perspective, same thing. Sweep them up. Before we dump, we sweep that previous high. We don't want everybody else to profit. Again, here, don't want everybody else to profit from last week, right? Let's go on the daily. After every up push, we have a nice sweep of the high, previous daily high, then run for the low. Another up push, sweep of the high, and then another down push. Push higher, sweep of all of those highs, then another run lower. You guys see it happening again and again and again. And when we go up high, push down low, sweep of the low, then we have 1, 2, 3 bullish days. Then another down push, sweep of the low, then we fly for another 1, 2, 3 days. Okay, guys, it happens again and again and again and again, right? You guys can see it here. Sweep of the low, then 1, 2, 3 bullish days. Then what happens over here? Sweep of these lows, then 1, 2, 3, 4 continuous pushes up. Okay, and so this is how I look at liquidity. Okay, this is how I personally look at liquidity. So something to take note of what you guys are doing this. Not just equal highs and lows are considered liquidity. Previous monthly highs and lows, previous weekly highs and lows, previous daily highs and lows, previous Asian, okay, and actually let's stop right there. Previous daily highs and lows, okay? So daily, weekly, monthly, those are all highs and lows that are areas of liquidity. And pay attention to this episode, because this information is going to be really useful when we are looking for exits and entries. Okay, so this is all leading up to how we're going to anticipate entries and exits. So understanding these concepts is crucial before moving forward. Okay, so we got our 4 types of liquidity: previous monthly high and low, previous weekly high and low, previous daily high and low, and intraday. Number 4 is intraday highs and lows, which include the Asian high and the Asian low, and then previous 1 hour highs and previous 1 hour lows. Okay, those are my 4 types of liquidities. Those are the 4 types of liquidities I mainly trade with. Those are you can say my bread and butter. Okay, so with that, guys, I'm going to let you guys go so that way you can digest this video. Again, the goal is to make these really short and simple and easy to digest. But please do not hesitate to leave any comments, questions, or observations that you may have made throughout this call, or anything that you may like. Okay, one thing that I will tell you, be on the lookout for another playlist that I'm coming with, and it's going to be all based around this is going to be all based around the application of these concepts. Okay, it's going to be a little bit more advanced, but once we finish this playlist and you get through all of it, I promise you the markups, the charts, the setups, the entries, the exits are going to become much, much more clear to you. And with that, guys, I'm going to let you guys go. Have an amazing, amazing rest of your day, week, month, wherever it is that you're at. I appreciate you taking the time to be here today, and have a good one, all right? Peace.